Hello, this is Sunko, the Korean bro. Today is 2023, November 21st. Let's start, okay? Bull market is coming to magnificent growth slashed by hand or fist before they soar 77%, 82%. Freelancers platform, Fiverr and Portalios. Let's briefly read off Fiverr. It's not the one that I'm focused on, but still I have much money inside Fiverr, so after pandemic era growth spurred to help drive the stock up more than 900%, Fever International stock has fallen on hard times. In the face of rising inflation and a cutback in business spending, demand on Favor's freelancer connection platform fell off a cliff. However, as inflation continues to cool and the economy outlook improves, companies are beginning to ramp up spending. Increasing confidence that the worst has passed is inspiring companies to start or resume projects that were put on the back burner during the downturn. As Fever's revenue growth took a hit, management turned its attention to profitability, an approach that is making solid progress. The third quarter revenue of 92.5 million climbed 12% year over year, and the company reported its second consecutive quarter of profits. Equally as important, Fever continues to deliver an improving adjusted EBITDA margin and growing operating cash flow, which paves the road for strong and consistent profitability in the future. Okay, not a single one recommends selling. $43, which implies potential gains for investors of 82%, though he didn't provide any commentary regarding the price target change. However, colleagues of RBC Capital were encouraged by Fever's improving take rate, success finding high quality buyers, and its progress going up market. Hmm. Next, for Chevron, PayPal operates three important services to drive the bulk of its payment volume. PayPal generates a ton of free cash flow, and using much of it to buy back shares. As the new CEO is trying to reduce expense and redirect the company's strategic focus. Solar Edge Technologies. NVIDIA has reported phenomenal financial results throughout the year due to strong demand for data center computing products, especially those related to artificial intelligence. Second quarter revenue soared 101% to $13.5 billion. Gross profit margin expanded 26 points to 70.1%, and non-GAAP net income increased more than fivefold to $6.7 billion. What's truly incredible is that management actually expects that momentum to accelerate. Third quarter guidance calls for revenue to grow 171% to $16 billion. It also calls for non-GAAP operating expenses to increase just 12%. And the discrepancy between that figure and the revenue growth figure implies tremendous net income growth. Of course, results like that are unsustainable over long periods of time, but investors still have reason to expect solid growth for many years to come. NVIDIA's graphic processing units are the gold standard in accelerating complex data center workloads. The company holds more than 95% market share in workstation graphics and machine learning processors. Its GPUs are synonymous with AI infrastructure. But NVIDIA is truly formidable because its portfolio also includes high performance networking solutions, subscription software, and cloud services that support AI workflows. Indeed, NVIDIA recently launched three cloud services for building generative AI applications. Three cloud services for building generative AI applications: Nemo for language applications, Picasso for visual applications, and BioNemo for biological applications. Those products came on the heels of its latest AI enterprise software, which helps business build and deploy AI applications that address use cases across virtually every industry, from retail and logistics to healthcare and financial services. In short, NVIDIA offers relatively comprehensive computing platform geared toward graphics and AI, and that puts the company in good position. Grandview Research says the AI market will expand at 37% annually through 2030. And Morningstar analyst Brian Kohler expects NVIDIA to grow revenue at 22% annually over the next decade. The only problem here is the valuation. Shares trade at 37.6 times sales, a substantial premium to the 3-year average of 23.5 times sales. Alternatively, shares trade at 22.4 times for sales, which is still a premium to the 3-year average of 17.6 times for sales. I have no plans to add to my position at the current valuation, nor do I plan to sell, but if I didn't have a stake in the company ready, I would probably buy a small position today. Apple. Apple growth story is a long one, but we're far from reaching the final chapter. Hmm. Well, the company sells a range of top products such as the iPhone, Mac, and Apple Watch. They keep fans coming back for the latest versions. Those products offer Apple a significant moat, protecting the company from a competition, and that's good reason to be confident about revenue growth over time. The technology giant also continues to attract new customers, another good sign for future growth. In the most recent quarter, half of Mac customers and two-thirds of Apple Watch buyers were new to those products, and both the iPhone and iMac installed base reached record highs in the quarter, which is positive for two reasons. First, actual purchases of those products equal revenue, and second, this client base now is ready to offer Apple recurrent revenue by purchasing services. And both the iPhone and Mac installed base reached record highs in the quarter, which is positive for two reasons. First, actual purchases of those products equal revenue, and second, the client base now is ready to offer Apple recurrent revenue by purchasing services. Apple offers a variety of services, from a digital content to iCloud storage, and this business could be a major revenue driver moving forward. In the quarter, services revenue reached a new all-time high, and the great thing about services is they are very profitable for Apple. With a gross margin of about 70% compared to a gross margin of 36% for products. Finally, with Apple, you get the ideal combination of growth along with the security of passive income. The company paid $3.8 billion in dividends to shareholders during the recent quarter. Apple shares have climbed 47% this year, but thanks to these points, they still have plenty of room to run. Let's see, Alphabet and Meta platforms. Okay, Alphabet current market cap is at $1.71 trillion, making it something of a shoe in to join the $2 trillion club, particularly since the Google parent has been there before. The stock originally surpassed its benchmark in late 2021, just as the downturn gained the momentum, ultimately taking the win out of Alphabet's sales. To rejoin the $2 trillion club, the stock would only need to increase its value by roughly 16% compared to Wednesday's closing price. To be clear, that's not a particularly high hurdle, working out to just 2.5% gains annually between now and 2030. Considering that Alphabet stock has increased by 245% over the past 7 years, this seems like it will be a cakewalk. There are numerous factors that will help drive Alphabet's ASIN over the next few years. First and foremost is a rebound in the digital advertising space, which suffered as a result of the downturn. As companies slashed expenses in the face of economic uncertainty, making budgets were first. Market budgets were first on the chopping block. They said with inflation cooling and recovery gaining steam, advertising dollars are beginning to flow once again, and Alphabet will be among the principal beneficiaries. Estimates suggest the global digital advertising market will grow from $531 billion to 2022 to $1.5 trillion by 2030, achieving a compound annual growth rate of roughly 14%, according to market research firm Research Markets. Alphabet is a digital advertising leader, hmm, controlling an estimated 30% share of the worldwide market last year. According to online marketing trade publication This Day, the improving economic picture and a freeing up of marketing dollars will no doubt boost ad spending. This development alone could restore Alphabet's membership in the $2 trillion club. The company will likely also benefit from the growing demand for artificial intelligence. The large language model that form the foundation of generative AI are expensive to develop, costing tens or hundreds of millions of dollars, putting the technology out of reach for all but the wealthiest companies. To help bridge the divide, Alphabet has developed its own cutting-edge models and is offering them free for a fee to its Google Cloud customers, which help fuel the next generation of its growth. Estimates vary widely, but most experts put the economic value of generative AI in the trillions of dollars. Over the past year, Google Cloud has been the fastest growing of major cloud infrastructure providers, placing it at the forefront of this paradigm shift and well positioned to benefit from the financial windfall resulting from the AI gold rush. Has been the fastest growing of the major cloud infrastructure providers, placing it at the forefront of this paradigm shift and well positioned to benefit from the financial windfall resulting from the AI gold rush. The trifecta of online advertising, cloud computing, and generative AI, all fueled by search dominance, should give Alphabet all the momentum it needs to rejoin the $2 trillion club. The king of consumer tech despite recent declines, Apple hasn't had the easiest year, with its revenue tumbling 3% in fiscal 2023 ended September 30. The company has suffered from a market-wide declines, which have caused significant reductions in consumer spending and sales declines across Apple's four product segment. Yet the company remains the biggest name in consumer tech and is likely to see consistent growth over the long term, from the immense brand loyalty it has achieved with shoppers. The tech giant holds leading market shares in most of its product categories, including smartphones, tablets, smartwatches, and headphones. Apple's success with its devices over the years has seen it attain the third largest U.S. market share in e-commerce after Amazon and Walmart, despite offering a significantly smaller range of products. The company might not have the dominance in online retail that Amazon does, but it's well positioned to see big gains as the market recovers and develops in the coming years. Meanwhile, the iPhone company is gradually expanding its position in e-commerce by venturing into fintech. Apple has so far launched its own credit card savings account and a buy now pay later program, which broadens its reach and makes its product accessible to more diverse range of consumers. In addition to e-commerce, Apple is prioritizing its role in the digital markets that are less vulnerable to economic declines. The company's second highest earnings segment services, which includes income from the App Store and subscription-based platforms like Apple TV Plus, Music, and iCloud. Services revenue growth of 9% year over year in fiscal 2023, outperforming all of Apple's other segments. Meanwhile, the company is heavily investing in AI, which could unlock more earning opportunities throughout the next decade. Despite recent hurdles, Apple hit fresh cash flow of close to $100 billion this year, compared with just $17 billion for Amazon with a PE of 31. Apple is a much more reliable and stable way to invest in tech, e-commerce, and AI over the long term. Alphabet, a more reliable AI investment. Alphabet and Amazon have been compared a lot this year, with both companies active in cloud computing and AI. Alphabet and Amazon, Google Cloud Computing and AI. Amazon has slightly overshadowed Alphabet with its leading market share in cloud services and rapidly expanding library of AI tools on Amazon Web Services. However, as with Apple, it's hard to ignore how much cheaper Alphabet is with similar growth potential over the long term. The chart above shows how Alphabet is a much bigger bargain than Amazon. With its significantly lower PE and price to free cash flow, Alphabet is taking a slightly slower approach to AI than Amazon and has largely used this year to invest in its business and develop its technology. However, the company plans to launch Gemini in the first quarter of 2024. Google Gemini, a large language model that is the product of massive data sets and is expected to be highly competitive against OpenAI's GPT-4. Moreover, Alphabet arguably has more earnings potential in AI than Amazon over the long term as the home of some of the world's most potent brands, including Google, Android, and YouTube. These platforms boast billions of users and have made Alphabet the biggest names in digital advertising. Alphabet's many popular services mean it has countless use cases for AI. Many popular services mean it has countless use cases for AI, from improving productivity tools to offering more pointed and efficient advertising, meaning the growing demand for AI cloud tools through Google Cloud, more accurate video recommendations on YouTube, and more. Alphabet stock has risen 153% since 2018, with Amazon shares up 82% the same period. The company is on a promising growth path that you wouldn't want to miss out on and is much more attractive option than Amazon. A bull market is coming to stocks, but growth stocks to buy before 2024. Okay, Shopify is a turnkey